If you're a parent or plan to be one someday, then you might just shudder at the thought of having to pay for college tuition in the future. And it's no wonder why. Tuition rates have only ever gone up, and they've increased pretty dramatically at that. Well, worry no longer, because if you watch this video all the way through to the end, you'll learn about an incredible way that you can save up for college expenses to support your current or future family. If that sounds interesting, make sure to save up that like button by clicking it to support this video in the YouTube algorithm. While you're down there, please also subscribe and ring the bell if you would like to be notified when new videos come out every Friday. They'll help you live a life you love through personal finance, investing, and self-improvement. Hi, I'm Evan, and let's talk about taxes. I promise it's a bit more interesting than you would think. I've talked quite extensively about tax-advantaged accounts on this channel, but I've never talked about this one in depth. 529 plans are tax-advantaged savings and investment accounts that are designed to help you save for educational expenses. They let you save, grow, and invest your money over time, plus their special tax benefits. You're likely familiar with the Roth IRA or the 401k. These are tax-advantaged retirement accounts, and they work with the same principle as 529 plans. The government gives you a tax incentive, namely paying less money in taxes, to use a 529 plan. It's just like how you get a tax break by using an IRA or a 401k to save for retirement. Specifically, 529 plans allow you to invest after-tax money that will be invested and grow tax-free and then can be withdrawn tax and penalty-free so long as the money is spent on qualified educational expenses. This is nearly the same thing as a health savings account. You can hear about those tax advantage accounts in more detail in a video linked in the description below. Beyond college, 529 plans can actually be used to pay for the educational expenses of K-12 schooling, as well as certain apprenticeship programs. So 529 plans help you save money over time and grow it for educational expenses. Sounds awesome, but how does it work? What are the limits? Unlike the tax-advantaged accounts, there actually isn't a yearly contribution limit for 529 plans. This means that you can set aside a huge chunk of change when your child is born, and then have a boatload of money when he or she is 18 and is ready to go off to college. However, some states actually do have restrictions on the total amount of money that you can contribute to a 529 plan. For example, Georgia has a maximum account balance limit of $235,000, meaning that once the account balance has hit this number, you can no longer contribute to that 529 plan, although investment gains and earnings will continue to accrue within the account. In California, the account limit balance is $529,000. This is a pretty wide discrepancy, and it actually brings up a very important point. 529 plans differ from state to state. In this video, I will be providing general information wherever possible. However, I will indicate state-specific information whenever necessary. I will be using my home state of Pennsylvania for provided examples. Now, there are two different types of 529 plans. There are college savings plans and there are prepaid tuition plans. Savings plans are the more common option, so we'll start talking about those. So who's eligible to open up a 529 savings plan? Well, pretty much anyone, so long as a child is the named beneficiary of the account. This just means that the child named will benefit from or eventually use the money from the 529 plan. The person who opens and owns the account is simply called the account holder. Account holders can be parents, grandparents, other relatives, and even friends of the family. You can actually open up a 529 plan for yourself if you're over the age of 18. This is an intriguing option if you're interested in going back to college at some point in the future, though of course you will need to have money to save and time for it to grow. As a side note, 501c3 charities are also actually able to open up 529 plans. They have no beneficiary until the funds are granted in the form of a scholarship. At that point, the recipient is the named beneficiary for the distribution or the paying out of the funds from the 529 plan. That's not super relevant, I just think it's very interesting. Anyhow, people can be the beneficiary of multiple 529 plans. This means that if you live in a state that has a capped account balance, then you can just make another 529 plan. So if you think your child may want to go to a very expensive school someday, and keep in mind that tuition is likely only going to increase from now until then, you and your spouse or somebody else can just start and contribute to a different 529 plan. Once you're an account holder and you've contributed some money to that 529 plan, you have to choose how the money is invested. Normally, there's a selection of different mutual funds. These are investments that pool a bunch of money together from a lot of different investors so that the fund has enough money to purchase a variety of different investments. Partial ownership of these purchased investments are sold as shares of the mutual fund. For example, let's look at some investment options that are available within the state of Pennsylvania. By the way, PA calls 529 savings plans as investment plans, but they're the same thing. There are 14 different mutual fund options to choose from. This gives account owners more options based on their financial goals and their risk tolerance. This choice can be distilled to what is called the risk return or the risk reward relationship. This means that investors are expecting to earn a higher return or a greater reward for assuming more risk. So you could invest in the safer total bonds market fund and receive about 2% a year. Or you could go riskier and pick the total stock market index fund and earn a bit under 9% a year. The main consideration with choosing investment options for the 529 plan is the time horizon. With traditional investment, investing, we talk a lot about pumping money into broad market index funds when you're young, since the market should be way up by the time that you retire, even with the occasional recession or two. The thing with 529 plans, though, is that you've got about 18 years in the best case scenario. That's if you start saving from birth until the time that your child goes off to college. Going all in on riskier investments means that the account's value could just plummet by the time that you need to start withdrawing the money. And that's where target funds come in. Traditionally, target funds are mutual funds that change up what kind of assets it holds periodically until it reaches the end or target date of the fund. The biggest example is retirement target date funds. These sell riskier assets with more growth potential like stocks to buy more less risky income generating assets like bonds. The idea is to invest and grow your money over time while you're still young. That way you have enough to be able to live off of less risky passive investments in retirement. Target funds in 529 plans act very similarly, although over a shorter time frame. The target date is set to the year of college enrollment for the beneficiary. If you plan on having a kid and opening up a 529 plan this year, you can already buy into a 2040/2041 school year target fund, at least in PA. Target funds simply make investing easier. Your portfolio will rebalance itself over time to become more conservative, closer to when the money will need to be withdrawn. This money can be withdrawn for educational expenses such as tuition, fees, room and board, and other expenses. Money can also be spent penalty-free on K-12 education, apprenticeship programs, and up to $10,000 worth of student loan repayment. So what about prepaid tuition plans? What's the deal with those? They're more rare than savings plans and are offered in fewer states and are limited to a certain selection of schools that accept them. They let you lock in the price of tuition as it is today. The catch is that you have to save up a full semester's worth of tuition in order to lock in that price. This prepaid rate will be the same no matter how much tuition has increased by in the future. Sources indicate that colleges raise tuition by about 1.5% to 3% per year, depending on what type of institution it is. The stock market grows by about 8 to 10% a year, and even with conservative investments, you can make about 5% or so a year. With that in mind, prepaid tuition plans lower potential for growth, requirement of putting in a lot of money up front, and limitations on which schools even accept them make them less desirable than savings plans. For example, PA's prepaid tuition plans, called guaranteed savings plans, only allow for students to go to PA state universities. And by the way, you actually don't even have to invest in your state's 529 plan. Doing so will likely get you a tax break, but it does vary state to state. So please do some additional research as to the specifics of your state. Speaking of tax breaks, that's the entire point of the 529 plan. Your after-tax money can be invested and grow tax-free, and then withdrawn tax-free to pay for the qualified educational expenses. If that money is withdrawn for other reasons, you'll have to pay federal and state income taxes plus a 10% penalty. It's very possible that you can have money left unspent in the account that you're not able to spend on qualified educational expenses. This will most likely be due to two reasons. First, your kid could have gotten a bunch of scholarships and thus didn't need all the money that was saved, or tuition in general was just less than expected compared to what you've saved. Second, he or she may have just decided to not go to college. At that point, you've got a few options. You can just withdraw the money and take the tax hit and pay the penalty. You can just leave the money to grow in case there's plans of the beneficiary eventually going to get a college degree or a graduate degree. If not, you can again just cash out and take the hit. You're also allowed to transfer account ownership. This is actually federal, so the rules are the same across the board. You get one transfer per year and the account has to go to a family member. Family member is defined by this big list. And finally, you can change the account's beneficiary. This one is state specific. Generally, the same list applies as to who can be named the beneficiary. This may be helpful if you have multiple children and not all of them eventually go to college. Swap the account's beneficiary to be another one of your children, and if they don't use up all of that money either, you can give the money to a relative or just cash out. Now let's work on answering the big question. How much should you save with a 529 plan? Obviously, costs are going to vary from school to school, whether it's public or private, and whether you're paying in-state or out-of-state tuition. Assuming we're saving and investing for a full 18 years, every dollar invested that returns a modest and conservative 5% annually will be worth $2.41 by the time we get to enrollment. The average cost of a year of college tuition across all four-year institutions was $28,123 in the 2018 to 2019 school year. If we take that average and grow it by 3% a year to account for tuition inflation, then we find an average year of tuition will cost $47,877.52 18 years from now. We grow that number 3 more times to account for the full 4 years worth of tuition you'll need to pay, and then summing that up shows that the average cost of tuition for a full 4-year program 18 years from now is going to be approximately $200,000. We can then use the future value equation and goal seek to show that you would need to invest $573.60 every month over the next 18 years in order to have $200,000 saved for college. If you want to learn more about the math behind that calculation or be able to make your own, there's another video video in the description. Please keep in mind that this $200,000 figure does not account for room and board or other fees and expenses. Tuition might also just not grow as fast as 3% per year. Investments might grow by more or less than 5% a year. This is just a general ballpark of potential future prices. Now make sure to get into the ballpark of the like button and click it if you enjoyed this video. Potentially subscribe and ring the bell if you would like to be notified of future uploads. Do you have a 529 plan? Will you be starting one? Let me know. Comment down below. And then click that video on screen to watch another that you're going to enjoy, and then please add some music, a 529 plan, or whatever else it is that you love to your day.